So we'll carry on indeed on the topic around transition and financing the transition. What we mean by that is really decarbonizing and electrifying the entire economies. And we've talked about this obviously for a long time. Throughout, I would say, sectors, stakeholders in the financial industry, in financial markets. As we've heard this morning from Lord Sharma, from Fukumoto-san, there has been a lot of work being done internationally. However, I think we'll all agree there's never been a more pressing time and complex time, actually, to tackle this issue. If we look globally, we have a combination of events we've never seen. We cannot be clear about our fossil dependencies with what happens in the Middle East. We really have a geopolitical dislocations, which means for environmental policy, you don't have the level playing field you kind of used to have when it came to having those global ambitious policies we need. And you have an unprecedented energy demand with the AI built out. So we are very pleased to have, to ICMA actually, to have gathered this panel this morning, which have together issuers, investors, and market stakeholders to look at, hopefully, what's working, what isn't, and where do we go from there. I'll let you introduce you maybe when we go to the first question very briefly. I'll start with you, Sinem. As a Turkish bank, really, QNB Turkey, you operate in a net importing economy when it comes to energy, and you have a wide range of industries. Can you tell us, in your experience, when you think of financing the transition, what does it mean from QNB Turkey? And if you can give us a concrete example of transaction that you think is working.
Yeah, sure. Thanks, Agnès. First of all, it's a great pleasure to be a part of such a panel. My name is Sinem. I'm heading the International Banking Department as well as Sustainability Coordination within QNB Turkey. And QNB Turkey is a leading private bank operating in Turkish markets. So Turkey is an emerging market, and industry is the backbone of this market. So sectors such as iron, steel, cement, aluminum, chemicals, manufacturing, textile, these are the drivers of production, exports, GDP, also job creation, employment as well. But on the other hand, these sectors are highly energy intensive and also carbon intensive. And unfortunately, or maybe fortunately, I don't know, Turkey doesn't have sufficient oil and gas reserves. So we need to import those energy from abroad, right? So this is creating a huge pressure on the economy. This is why we keep running current account deficit all the time. When we exclude energy imports, we don't have current account deficit. So whenever there is a crisis, whenever there's a volatility in the global markets, like the one that we are having right now in the Middle East, we immediately feel it in our current account deficit, in our inflation, in our FX reserves, in our exchange rate as well. So this is creating a burden on the economy. So we need to do something. There needs to be a structural change. We need to lower our dependency to fossil fuels, and we need to switch to renewables. That's the solution. And because of that, energy transition, is not just a climate issue, it's not just a climate conversation for economies like Turkey. It's also economic stability conversation. It's also energy security conversation. And for such a structure, it's not enough to finance what is already green. We need to finance, we need to channel the capital towards highly carbon-intensive sectors that are emitting high carbon today, but also do have credible, measurable decarbonization plans. And we need to invest more on processes that lower the fossil fuel dependency, such as electrification, energy storage, batteries, fuel switching technologies, decarbonization technologies, and such. I think this answers the question. But one last thing before leaving the floor to my colleagues. This year, Turkey will be hosting COP31 at Antalya. And we aim this COP to be an implementation COP rather than just giving the promises. And I guess for COP, energy transitioning, transition financing, energy security will come front in the agenda. And I'm looking forward to meet you there to have meaningful discussions that can be converted to action.
Thank you, Sinem. Alban, I'll turn to you to carry on with kind of the investment side. As a fixed income investor, how do you look at translating this broader concept of financing the transition into really concrete portfolio strategies that we need for that transition?
Good morning, everyone. First of all, thank you for this invitation. So my name is Alban de Failly. I'm leading ESG investing for the fixed income platform at Amundi. I'm part of the dinosaur we saw yesterday as I'm managing ESG credit portfolio since 2004. So just to highlight that ESG and fixed income is not something new. For me, it's important to remind that at Amundi, we strongly believe that we need to fight climate change and social inequalities. And as a responsible investor, financing the transition is key, and even if more for sectors and issues that are exposed to high climate risk. Having said that, when we move to portfolio strategy, we have two ways to really finance the transition. The first is what we call a net zero strategy, where we leverage on the issuer. And the other is what we call an impact strategy, where we will leverage on the project and green bonds. For the first strategy, the idea is not to only finance the leader, but also issuers that are a very nice pathway and make effort to move forward and to reach the Paris Agreement. To look at this and to make our choice, we look at different criteria. We look at the current carbon emission, but also the trend of this carbon emission. We look at the carbon reduction target. Does the issuer have a clear carbon reduction target? We also take into account the ability of the issuer to decrease their carbon emission. And we have also some criteria on physical risk, bond exposure. Everything is to better understand where the issuers stand and what is this pathway to build our confidence to finance this issuer. Another very important criteria is also a just transition. So one more time, we cannot dissociate environmental and socials. And we want to be sure that issuers are also paying attention of the social impact of the transition. So how they deal with employees when the business is fully changes, how they deal with local impact if there is some move in the business and all the societies. So for me, it's important to remind this because the consistency and the confidence we may have at the issuer level is key to finance the transition. And it's true that we have dedicated instruments that can help, but we have to trust issuer first. And just to remind that also bondholders are a key stakeholder of issuer. Most of fixed income investors are long-term investors. So we are a key partner for issuer to finance the transition. So we have to work together and to build this confidence. The second way is to leverage on the green bond market. Thanks to the transparency, we can leverage on the benefits of the project finance and assess the impact and answer a lot of requests from investors that want to better understand how their money is used, what is the impact of this investment. And clearly, this second way is to finance solutions with a very high level of transparency. The benefit is very important because the message is very clear from the issuer to the final investor, even if it's retail investor. So just to remind that we have a strong appetite on the green bond market, and we are very happy to see issuer coming on the market. It's also the ability of the issuer to demonstrate their knowledge about their business, their ability to provide a high level of transparency, and to measure the future environmental impact of the project they want to finance and build their sustainable business.
Thank you, Alban. Yeah, so it's always important to remember, effectively, strategy and projects are the combination of a whole, and whether they are green or we'll talk about kind of projects that go beyond that, they all contribute to the same goal. Takada-san, we heard earlier from your colleagues, effectively, how Japan has been really at the forefront of transition finance from many perspectives, I would say. As the GX Acceleration Agency, you are really in charge of accelerating that transition. What do you think has worked in Japan that can be effectively exported and tried in other geographies?
Well, thank you very much. I'm Hideki Takada, the director at GX Acceleration Agency. And my colleague, the previous speaker, Mr. Fukumoto, already touched upon the overview of Japan's GX policies, but let me elaborate on some of the aspects. So our organization, GX Acceleration Agency, was launched by the Japanese government in the summer of 2024, or just about 2 years ago, to accelerate Japan's GX green transformation, and particularly to accelerate private sector investment into GX. And for that purpose, we are taking forward 3 pillars of work. The first, we provide financial support, such as credit guarantees or equity investment into private sector GX projects. So basically, we can provide blended finance. And secondly, as mentioned by Mr. Fukumoto, the efficient trading system has just started in Japan from this April, and our organization will administer this system. And thirdly, we are acting as a GX hub, which brings together financial sector, industry sector, and the government sector to work with diverse stakeholders to drive forward the GX in a society-wide manner. And so, as you mentioned, Japan has been leading the international discussions on transition finance, and what worked well in Japan. So there could be many things I could mention, but if I just choose one. So as mentioned by Mr. Fukumoto, we have developed the frameworks for transition finance, such as basic guidelines and sectoral roadmaps. And throughout this process, from the outset, the industry and financial sector and the government has been working very closely together. So this joined up approach is very essential for transition finance, because transition finance is not only about climate policy. This is not only about finance, but this is about the industry process itself. So that is why this kind of integrated joined-up approach is needed. And even within the government, many ministries are working together. So the Ministry for Industry and the Financial Services Agency, Ministry of Environment, working together. And of course, the climate transition bond was issued by the Ministry of Finance in cooperation with those ministries. And actually, the organization, the GX Acceleration Agency, is a kind of manifestation of such a joined-up approach, because in this organization, the people are seconded from many different ministries, as well as private sector people working together under one roof, literally side by side. I think this is something that can be replicated in other jurisdictions as well. Thank you.
Thank you, Takada-san. Yeah, so it's effectively working, many things, but working very closely with the industries and public-private, effectively, cooperation. We'll zoom out a bit more to the macro environment, first with you, Gourc, if I can. I was touching upon the conflict of the Middle East, the geopolitics, the AI, really, investments. At PIMCO, what are the impacts of these changes that you see emerging in terms of really the flows of capitals, whether they are redirected or not?
Sure, thanks, Agnès. And I have to say, I think that was a personal invitation to Turkey, so hopefully I can make that. I look forward. So at PIMCO, I lead our ESG and sustainable investing efforts and portfolio management, and it's an incredibly interesting time. One of the byproducts or consequences of a lot of the geopolitical volatility and unpredictability right now is in the context not only of energy transition, but broadly, is this increasing appetite for asset-related financing. So you see that in infrastructure, you see that in energy, you see it in asset-based finance, where we're increasingly active. And this bodes well in the context of more investment opportunities, right? These are high CapEx sectors. Pipelines are very full. There's a lot of ability to do direct sourcing. But then also you have the benefit of some resilience and protection against what's really this increasing risk of AI disruption and the less CapEx-heavy industries. So the dual benefit of increasing real asset project finance-based opportunities as well as some AI defense. But with that said, right, this is also leading to somewhat of a collision or overlap between public and private markets, where just the size of a lot of these fundraisings, the size of transactions, the CapEx building in the economy, leads to deals that have arguably some degree of higher execution risk in the market, where the operators, issuers, borrowers, the sort of certainty of execution is very, very important. And so having direct conversations, interactions with these borrowers can be very, very beneficial from an investment perspective, giving them that certainty, but still allowing some liquidity, having these be tradable securities, and having there be an active market, and everyone's familiar with sort of the attention on marks and private capital and private lending right now. And so you take all that together, and then in the context of the energy transition, well, what does that mean? I mean, I like to say the transition itself is transitioning, or transition squared, right? So a lot of the pledges, a lot of the policy related to decarbonization, this was made in a relatively benign energy demand growth environment, particularly on the power side. And so it's quite difficult to transition when the supply or the stock from a capacity or a generation perspective is facing demand growth that was completely unpredicted when a lot of these projections or pledges were made. And so as the previous panels noted, as some of my colleagues here have highlighted, the market has to accommodate, it has to grow, it has to be increasingly accepting of incumbents of a lot of different types, of let's say, positioning in terms of eligible categories, right, and really trying to react and provide liquidity and capital to the market to meet that demand while still prioritizing, right, energy efficiency and lower carbon opportunities where possible.
Yes, some changes happening, but what I like obviously between yourselves and Alban is that definitely there is a big importance of debt investors in that transition at all stages actually of the investment. That's always key. Takada-san, I'll come back to you. So you were highlighting the trajectory of Japan. In these current challenges that do impact Asia to a big extent, how do you see the approach to transition evolving? Grover was highlighting its transition square. Where do you see it going from now on?
Yes, thank you very much. So just looking at the current geopolitical challenges we are seeing, actually these geopolitical challenges, most notably the energy supply shock in the Middle East, actually necessitates the acceleration rather than slowing down of energy transition and green transformation. So because the current energy supply shocks just reminded us about our potential risks. That Japan is still heavily depending on the imported fossil fuels, mainly from the Middle East. So just this current crisis reminded us about the vulnerability of such a dependence. And in some other Asian economies, these shocks are actually impacting the economies more acutely than Japan is seeing. So we need to accelerate energy transition and reduce the dependence on imported fossil fuels. So this is not only for the sake of decarbonization, but also for the sake of energy independence and security and economic security. And actually, we could turn these challenges into opportunities because the current the surge in the prices of fossil fuel is actually enhancing the relative competitiveness of the cleaner solutions, such as renewable energy or electric vehicles. So we could now accelerate the energy transition and green transformation, and these geopolitical situations are providing a stronger narrative for accelerating these efforts. And actually, Japanese government is now trying to strengthen these narratives to the nation and also to the world. Thank you.
So in a way, we have several motivations for that transition, energy independence, security being one of the key ones today. Toby, I'll turn to you, and as head of carbon markets at Rand Merchant Bank, maybe you hold the keys actually to many of those issues. What specific financing mechanism do you see emerging that link carbon credit trading to transition in Africa, in your main market? And maybe if you can tell us which opportunities, obstacles, which one is more, do you think will shape the scale-up of those mechanisms over the next few years?
Okay, thank you, Agnès. Yes, I'm Toby Campbell-Cahoon, and for my sins, I've been involved in carbon markets for 25 years, sort of on and off. So I've seen a few things over that time. But I'm going to just explain a little bit why I'm still passionate about why we need to try and put a price on carbon and how that enables the different tools that we have within the sort of amongst us as financial institutions. So if we talk about carbon pricing, typically it comes in three forms. You can have a carbon tax, you can have a carbon price that's determined as a consequence of a cap placed on, for example, industrial emissions, the EU emissions trading scheme being the foremost example of that. And then we have baselining credit, whereby you can have a project where you demonstrate that you've reduced emissions versus a baseline, and you can monitor and report and certify those that sort of delta, and then you can trade those as carbon credits in the market. Now, for years, I think going back to sort of COP8 in 2002, we were banging the drum for needing to have a firm carbon price determined by sort of clear, forward-looking targets, which are set for a number of years out, which enables the development of a forward curve on carbon, a tight bid-offer spread, an ability, therefore, for companies to hedge and make investment decisions today based on the price of carbon that's being seen on that forward curve, and then for financial instruments to be created on the back of that to help finance those markets. And we see that, within the EU scheme. However, when we come to the sort of the baseline credit, the carbon credit market, this is a market which is trying to deal with some of the most sort of thorny or trickiest ways to reduce emissions. So everything from avoided deforestation to reforestation, clean cooking, regenerative agriculture, all areas which are much harder to measure emission reductions than sticking sensors on power plants or cement factories, etc. But it's worth persisting with these because the sustainable development adjacencies are massive in terms of the benefits it can lead to the communities who will rely on clean cooking and the like. And so what we've had in terms of the carbon credit market, because it's very much on a journey, we're creating more robust methodologies. There have been a lot of challenges around how we measure those emissions reductions, how we ensure that they are permanent. There's been a journey for those to be accepted beyond the sort of the voluntary carbon market. And so it's actually the voluntary carbon market, whereby typically actually oil and gas or technology companies have been the largest buyers and funders of carbon credit projects to fund emissions reductions, typically across developing nations. But what we are starting to see is that with the development of Article 6 under the Paris Agreement and with increased robustness associated with some of those methodologies, the ability for some of those carbon credits to be, we're seeing discussions around how they can be used within compliance markets. So within potentially in the future, the EU emissions trading scheme, how they can be used to meet targets under an aviation trading scheme today, how they'll be used to reduce liabilities potentially under the carbon border adjustment mechanism in Europe. So discussions live on how and what types can be used. Now this for me is quite exciting because if you look at the carbon credit market today, you can look at a price reporting agency and see 100, 200 different prices. that doesn't help us with developing a forward curve. That doesn't help us with assessing price when we're trying to finance something up front unless you have a firm off-taker up front. So we want to see that harmonized price, and that only really takes place when you start to see it linking into a compliance market where the price is meeting that compliance target. Now, in the short term, some of the interesting products that we're seeing beyond standard financing are we're seeing various carbon credit outcome-linked bonds. So we've seen those associated with water filters in Vietnam. We've seen them for reforestation or protected forestry in the Amazon. We've seen them for clean cooking in Ghana. Recently, we've seen it with spec boom planting in South Africa. Now, all of these have required a specific off-taker, so that if the project performs, the off-taker will pay for those carbon credits. That can lead to an increase in the coupon being paid to investors. But as we start to see that link with compliance markets, and you start to see a harmonized price, then we can start to see other bond-linked products where you don't necessarily have to have an off-taker up front, but investors are willing to put money into it today because they know there will be a market into which those carbon credits can be sold. So for the next few years, that's what I want to see developing. That's the direction of travel that we need to be heading.
Thank you, Toby. So we'll move a bit more into the technicality of different instruments, and you started now. Actually, my colleagues worked on the recent spec boom outcome bond, and definitely harmonization would be key across the value chain of those transactions, including on the pricing of the carbon credit. Fully on board with that part. If we look at more the instrument side, and we are at the main ICMA conference, so I'll mention quickly, just as a start of the next few minutes discussion, maybe some of you, hopefully many of you are aware, at the principal, so the ICMA principal level, we published a climate transition bond guidelines back in November. So that's an instrument guideline. Actually, Alban and myself as vice chair of the ExCom, Grover, also a member of the ExCom. So that's really going more into, once we've laid the ground of we need transition finance happening, that's one of the new tools in your toolkit, if you want. And we'll spend a bit of time looking at what does it mean, how is it working today, how do we scale it up. Just for a quick definition, it's effectively about identifying project which scopes goes beyond the green project that Alban, for example, was referring to earlier, but still all in the pursuit of achieving the goals of the Paris Agreement. So I'll start with you, Sinem, because obviously QNB Turkey has issued actually the first ever climate transition bond under those guidelines back in December. What was, if you can tell us, what was the motivation and also your experience with the transaction?
Yeah, definitely happy to share the experience. It was an interesting one. So in the first question, I tried to answer and give some background about the structural challenges that we are facing in Turkey. And with that context, Turkey committed to become net zero by 2053. And as a leading bank in Turkey, QNB Turkey also aligned its strategy with national commitments. So we also target to become net zero by 2050. And this target is actually going beyond our operations, because for banks, I think you all know, almost 99% of our emissions are coming from our financed portfolio. So the aim is to actually lower the carbon intensity of our loan book. Having targets is great. It's a great start to initiate something, but not enough. You have to operationalize it. You have to have a well-functioning governance system that embeds climate consideration into daily business. And to be able to function that system, you have to have a tool. And actually, the transition bond kind of financing tools are great tools to function that system. Why? Because it channels the capital from international capital markets to real economy, to the right direction, to the right investments. Banks act as a bridge. But along with the capital, it also helps to mobilize the know-how to real economy, and this is pretty important. At that point, I would like to, the climate bond transaction that we issued with IFC by the end of last year was a great example for it. It was a $100 million bond. The only investor was the IFC. It was a 5-year bond. And IFC was not just an investor, they also acted like a partner. We sat down together, we identified eligible loans in our portfolio. We then, with their guidance, aligned our internal policies, governance system with international best practices using ICMA guidelines for sure. And we actually benefited a lot from the technical know-how that they have, and we spread that knowledge internally between our departments. We trained our departments, we trained our relationship managers, and today, our relationship managers are not just discussing about credit lines with our customers, but they also discuss about their transitioning plans as well. So this is a great example how these kind of financial structures can create a real impact. I think it would be worth to mention something. These transactions have maturities for sure. Capital will fly away, but know-how stays. So it is kind of an investment for future for the organization and for the company to meet the ambitious climate goals that we have.
So I guess two things. There is a technical knowledge effectively to be developed, and that's quite to some extent new in some areas when we start discussing transition projects, but also it's a key tool in client engagement as banks, so that's definitely key. Alban, so obviously, green bond has been our specialty to few of us for many years, and that has been a very successful instrument, but it remains concentrated, if we're entirely honest, in some sectors, utility, transport, real estate. How do you approach climate transition bond instruments? What would it take so they become really an integral part into your strategy?
It's true that it's important to remind that the green bond market reached a very nice ecosystem, and we have already mentioned we have appetite, and we really support the development of this new climate transition bond, but at the same time, we want to be sure that it will not harm this green bond market. So the big issue behind transition is how you make the line between green project and transition project. So for us, it would be very interesting to see how issuer explain to the investor what are the line, what are the criteria, in which taxonomy they base to make the difference. Currently, climate transition bonds are not eligible to our dedicated pure green bond strategy because it's not a green bond strategy. Currently, we manage more than 9 billion dedicated green bond strategy, but it will be eligible for other net zero strategy. And for me, to be short, looking at the time, the success of this new instrument for me will be on the ability of the issuer first to explain the need to finance this project and how they define the line between green and transition, and their ability to assess the environmental benefits and to evaluate the impact. Clearly, if an issuer comes with a transition with this information, a lot of investors are looking for impact, and it will be, for me, a game changer if we are moving in this direction.
Thank you, Alban. So I'll pass on to you, actually, Toby, then, because as many of the hats you are presenting today for the institution, at first round, you now have established a transition finance framework. How do you think tools like this support the acceleration of the transition in Africa, and if there are some link to Alban's request?
Indeed, it's just a couple of numbers. So to begin with, we heard a recent estimate that there's about $400 to $500 billion over the next 5 years required to fund the transition across Africa. And currently, I think around 2% of what goes into sustainable finance is going into sort of transition bonds per se. But we think they're a growing and key part of the toolkits that we have to deliver that transition pathway. So for us as a bank, we have our own financed emissions targets to get to net zero by 2050. And the transition framework that we've put in place essentially tells everyone how we're going to get there. And as we've spoken about earlier, transition finance isn't necessarily about solving all of the, there's a lot of money going into green products. But there are a lot of hard-to-abate sectors where there isn't proven technology to get to zero today. But we still need to fund the pathway to fund where incremental emissions reductions can happen, where emissions intensity can be lowered today. And so what a transition framework allows us to do is to spell out what our trajectory is, what our tools are that we can use from a financing perspective, how we're going to use them, and how we're going to assess companies and assets, activities to say whether they fit within the pathway that we're pursuing to hit that sort of net zero financed emissions target. So in particular, we talk about the hard-to-abate sectors, but then we also talk about some sectors such as agriculture in some cases, some power in some areas, where actually the technology is more proven, but the capital isn't flowing there yet. So how can we enable capital to go into those areas? And the third is actually the transition adjacent technologies. So we're talking about critical minerals. How is it that we fund projects that will create, that are fundamentally needed to deliver on that sort of decarbonisation pathway? So those are kind of the three buckets that we will look at. And if we give an example, if we look at the cement sector, what we would be encouraging is to say, can we help support where we're changing the feedstocks for cement, so to move away from coal to other sort of waste products? Can we change the types of clinker that are used? Can we move towards renewable energy rather than fossil fuel-based energy on site? So how is it we can deliver on that pathway? So that's the kind of example. And the activities are across energy efficiency, renewables, cement, agriculture, and the like. Now, with a framework like this, and the timing was very good because this aligned, I think we were the first global framework to align with the ICMA guidelines as it was released. And this was not an overnight process. There were, for example, 3 to 4 years of us working with BII to put together the framework that we were looking at to stimulate $150 million of investment from BII that we can then use. But the framework also, while going into detail on what we can do on specific activities and specific areas, needs to be monitoring, reporting, verification. There was third-party approval from Moody's to come in and say, yes, it fits within the guidelines, it fits within the ICMA guidelines. And this is what enabled, as I say, that sort of catalytic capital coming through. So it's quite intensive in terms of that annual monitoring, but it's that clarity that is given to investors that enables people to put their money into this space. And what we're now doing is helping clients put in place their own transition frameworks to be able to spell out their pathways to net zero and how we can support that.
Thank you, Toby. So we touch really upon here specifically helping sectors with how to abate emissions in that change that they need to make. So Grover, we'll conclude with yourselves. That fits into investors, your end investors today. When you talk about sustainable investment, they really want to see that real economy decarbonization. By that, maybe for the broader audience, we mean versus divesting, having really access to those sectors that will decarbonize the most, or that will need to decarbonize the most. How do you see climate transition bonds playing a role in this process?
Sure. So this is really the fundamental question. Alban and Toby made great points, which I agree with. What I would add is the intent, right, for the market and putting out the ICMA guidance and having discussions like this is we want to grow the investment universe. We want to broaden the tent, if you will. And so the green bond market, right, has been a success, right? I think we can say that. And still has tremendous tailwinds behind it in the future. But the transition concept should not cannibalize that. And to Alban's points, there will be differences. So what we hope to see is that the transition label, the transition concept, transition finance, as a strategy that many of our clients are increasingly interested in, can bring more issuance activity, more fundraising, more investment opportunities. Many of the sectors have already been highlighted in terms of whether it's chemicals or steel, hard to abate. incumbents even in the energy space, right? We believe we're also in scope. That has the additional benefit, of course, of giving more diversification to portfolios. Many accounts, strategies with climate or carbon-related objectives may be underweight or even void some of these sectors because of the exclusions or restrictions that they have. To facilitate that diversification will have obviously favorable implications for risk-adjusted returns. But there's still some frictions in the market. We'll see in terms of where SFDR 2.0 goes, the current SFDR construct. The regulatory backdrop is not necessarily fully equipped to facilitate the growth that the market could have. Certain issuers will be able to satisfy that. Certain mandates may adjust. We'll see what happens over the next 2 years. But I think that there's enough attention and ambition in the market overall to find solutions here, and so quite optimistic.
Thank you very much, Grover. Thank you very much to all of you. We've given you a bit of a whirlwind review of what's happening, what needs to happen, but hopefully, looking ahead, it should bring lots of opportunities for everyone. Thank you.
Thank you.